20, 30 or 50 lakhs. How the bank checks your credit health to decide your home loan and interest rate? It is around 10 o'clock at night. A middle-class family is sitting at the dining table, a property brochure is lying in front of them, and the EMI keeps changing on the mobile calculator. The father is saying, if we get a loan of 30 lakhs, the house can be built. The mother is quiet, because she knows that the savings have already been spent on the land. The next morning, the family reaches the bank. They think that just by showing the salary slip, the loan will be approved. But the bank officer's first line completely shakes their confidence. He says, the house is good, but first we need to check your credit health. The loan amount, tenure and interest rate will all be decided based on that. This is where the suspense begins. Does the bank only look at income? Is the CIBIL score everything? Or are your money habits silently building a report against you? A home loan is not just a financial product for any middle-class family. It is the biggest decision of life, where the dream is big and so is the fear. Someone needs 20 lakhs, someone needs 30 lakhs, someone needs 50 lakhs. But the bank does not decide this amount by looking at your wish, it decides by looking at your repayment capacity. The bank's job is not just to give a loan, its job is also to check whether the borrower will be able to handle the EMI for the next 15, 20, or 25 years or not. Therefore, when you apply for a home loan, the bank does not look at just your current salary. It reads your financial story, just like a doctor reads a health report. First of all, the bank looks at your income. The salary slip, Form 16, ITR, bank statement, rental income and business income, every source is verified in a different way. If you are salaried, the bank looks at the stability of the salary, how reliable the company is, how old the job is and whether the income comes regularly or not. If you are self-employed, the investigation goes a bit deeper. The bank tries to understand income consistency through the ITR, GST data, profit-loss statement, balance sheet and bank transactions. Many people think that high income means an automatic high loan. But the bank does not just look at how much money comes in, it also looks at how much money is saved. This is where the second big thing comes in, monthly expenses and savings patterns. If your income is good but your expenses are also very high, the bank's confidence might drop. Your habits show up in the bank statement. Whether the entire account gets emptied as soon as the salary arrives or some amount is left over, the lender silently observes this. If credit card bills are heavy every month, a shopping EMI is going on, a personal loan is being deducted, and the account balance remains low, then the income can look weak despite being strong. The most important thing for the bank is the monthly surplus. That means how much money comfortably remains for paying the EMI after necessary expenses and existing obligations. The RBI's home loan guidance also speaks about factors like monthly disposable income, expenses, liabilities, spouse income, assets, and income stability in repayment capacity. Now the third thing comes existing loans. How much loan you have taken before and how much EMI is currently going on directly affects home loan eligibility. Suppose your monthly income is 80,000 rupees but 35,000 rupees are already being deducted combining a personal loan, car loan and credit card EMI. In such a case, the bank will think about how your household expenses will run after adding the new home loan EMI. The salary is big, but the breathing space is less. This is the reason why many people end up liking the property. The income also seems fine, yet a lower loan amount gets approved. The bank generally looks to ensure that the total EMI burden remains reasonable compared to the income. Many lenders understand this through FOIR or debt-to-income logic. If the existing loan is high, the borrower can have two ways. Either close the loan or add a co-applicant to show a combined income. But a co-applicant does not work just for the sake of a name. Their income, credit score, age and repayment history also come under the bank's watch. The fourth and a very crucial thing is the credit score. In India, the CIBIL score ranges between 300 and 900 and a higher score indicates better credit behavior. According to CIBIL, this score is a numeric summary of your credit history. Factors like payment history, credit utilization, credit age and inquiries impact this. If you have paid credit card bills on time, have not delayed EMIs, and have managed loan accounts responsibly, the score can be stronger. But a missed EMI, late payment, settlement, high credit utilization and frequent loan inquiries can make the score weak. In a home loan, the credit score can be important not just for approval but also for the interest rate. A good score signals lower risk to the lender. Many banks use risk-based pricing. This means that a borrower with a strong credit profile might get better terms, while one with a weak profile might get a higher rate or rejection. There is a very big confusion here. People say my score is above 750, yet why did I not get the loan? The answer is simple: the score is important, but not alone. If the score is good but the income is unstable, the bank statement is weak, the property documents are unclear, or existing loans are high, the approval can still get stuck. The fifth thing is age. A home loan is a long-term commitment, so the bank looks at how much earning life is left for the borrower. If the borrower is young and the income is stable, they might get a longer tenure. A longer tenure makes the EMI look smaller, so eligibility can be slightly better. But if the age is higher, the bank may keep the tenure shorter, because there remains a risk of regular income decreasing after retirement. In the case of a self-employed borrower, both age and business continuity are looked at. How many years the business has been running, and whether the future income is predictable or not is important. Now comes a hidden factor, which many buyers ignore. This is the property value and loan-to-value logic. The bank does not give you the full price of the property as a loan. It decides how much it is safe to finance by looking at the property's valuation, legal status, and internal policy. Therefore, a 50 lakh property does not mean that a 50 lakh loan will definitely be given. The buyer has to keep money aside for the down payment, stamp duty, registration, and other charges. Many families make this very mistake. They only calculate the EMI, but forget costs like the upfront cost, processing fee, legal charges, and insurance. Property documents are also just as important as your income. If the title is not clear, approvals are incomplete, or the property is in a dispute, the bank can stop the loan. The bank considers the property as collateral. If the borrower is unable to pay the EMI, the bank needs a way for legal recovery. Therefore, property verification is very strict. Along with your credit health, market conditions are also connected in deciding the interest rate. In India, floating home loans are often linked to benchmark rates. In June 2026, the RBI kept the repo rate unchanged at 5.25%. Repo rate changes can affect floating home loan rates and EMI expectations down the line. But the borrower should not just look at the headline rate. Things like the processing fee, reset frequency, spread, benchmark, prepayment rules, and APR should also be understood. The RBI has set borrower-friendly expectations in floating-rate personal loans, such as communicating the impact of interest resets and providing quarterly statements. If the rate increases, the borrower should understand the options. Whether the EMI will increase, the tenure will increase, a fixed rate switch is possible, or part prepayment can be done. This should be clearly asked from the lender. Now the question is, what is the difference between a 20 lakh, 30 lakh, or 50 lakh loan? The difference is not just of the amount but also of the risk. The bigger the loan amount, the heavier the EMI will be. The heavier the EMI, the more income stability and credit discipline the bank will look for. If the borrower's score is fine, income is stable, and expenses are controlled, a 20 lakh loan can look manageable. But if the same borrower asks for a 50 lakh loan, the bank may demand more documents, more scrutiny, and stronger repayment proof. This is the reason why, even when the salary of two people is equal, the loan offer can be different. One's score is strong, expenses are low, and property is clean. The other's liabilities are heavy. The borrower's profession also gives a signal to the bank. A government employee, reputed company employee, established professional and stable business owner can be viewed through a different risk lens. But no profession gives an automatic guarantee. If the payment history is bad or documents are weak, even a strong job cannot save the loan completely. Many people use up their full credit card limit before applying for a loan. They feel they will pay it before the due date, but the risk can show up in the utilization report. Keeping credit utilization low is a useful habit for credit health. Because high utilization can give a signal to the lender that the borrower is heavily dependent on credit. Applying for a loan repeatedly can also become a problem. If too many hard inquiries are seen in a short period, the bank might think that the borrower is desperate. Therefore, you should check your credit report 6 months before a home loan. If there is any wrong entry, you get time to raise a dispute and get the correction done. CIBIL itself says that if inaccuracies are seen in the report, a correction request can be made through the dispute process. It is smart to do this step before the loan application. The preparation for a home loan should begin before looking at the property. First, check your credit score, bank balance, existing EMI, and emergency fund, then finalize the budget. A practical rule is that the EMI should be such that you can handle it even in a bad month. Taking a loan just by looking at the best-case salary growth can be risky. If there is a child's education, parents' medical needs, or business uncertainty in the future, the home loan amount should be taken thoughtfully. The dream of a house is emotional, but the loan calculation should not be emotional. The bank does not see emotion, it sees numbers. If your income is cash heavy and does not reflect properly in the bank account, the loan eligibility can look low. Therefore, it is necessary to keep financial records clean. Self-employed people can get a better chance upon showing at least 2 to 3 years of clean ITR, a proper banking trail and business stability. Salaried people should also be careful at the time of job switching. Too frequent job changes can show a stability risk to the lender. Adding a home loan co-applicant can be helpful, especially if the spouse has a stable income. This can increase eligibility, but the responsibility also increases jointly. Before taking a loan, one should carefully read the key fact statement and sanction letter from the bank. Signing just by looking at the EMI amount can prove expensive later. Whether the interest is fixed or floating, when the rate reset will happen, what the foreclosure charges are, whether insurance is compulsory or optional, all these questions should be asked at the beginning. If you are being approved for 30 lakhs, it is not necessary that you must take the full 30 lakhs. Take only as much loan as your life can comfortably bear. The joy of getting a house feels good, only as long as the EMI does not consume the peace of the house. Over-borrowing can turn a dream into stress. Therefore, look at your credit health like a mirror before a home loan. Income, expenses, existing loan, credit score, age and property all together make the final decision. If the bank rejects you, do not take it as a personal insult. This can be a financial signal that preparation is still left. Your profile can get better by working on EMI discipline, credit card control, savings improvement and report correction for 6 months. A home loan is not the destination, it is the beginning of a long journey. Getting the approval is not the victory. Continuing to make repayments on time is the real victory. Whether it is 20 lakhs, 30 lakhs or 50 lakhs, the bank's question always remains the same. Will this borrower be able to return the money reliably for the coming years? And if the answer to this question is given strongly by your credit health, then the dream of a house does not remain just a dream. It slowly turns into the key to your name.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.